Okay, what a week. After last week's semi disaster, we recovered. If you are a bull, it was a good week for you. Um, my opening comments are going to be that the Fed is kissing the south end of a north moving bull market. And that's just what's happening here because the bull market doesn't really care about the Fed. And while everybody else is talking about the Fed, the market moves on. I guess that's another saying: when the chips are down, the buffalo move on, right? Um, so, we are hitting uh, our stride in the bull market. I want to show a few things in here that kind of support what's happening in the market um, and why I believe it's likely to continue at this point. Doesn't have to, but there's more and more evidence, at least in my mind, that this thing is going to end similar to the kind of a combination, I think, of the dot com bubble bust and the great financial crisis. I think it's going to be a combination of the two, to be honest with you. Um, so what are the things that are kind of driving this right now? For the most part, it's irrational exuberance, which is the term that Greenspan coined back. I think it was for the dot com bust, but uh, the things were getting way out of hand. I think they're going to at this point, and again, I'll show you here in just a minute why I think so. Um, and the other thing that happened this week is there were a number of uh, body shots that woke capitalism took this week. The student loans. I mean, just a combination of things. The student loan portion, the affirmative action component, um, really took a lot of the large businesses took some shots this week on stuff, and that's on top of all of the boycotts of Target, and Nike, and Bud Light and Disney, and all these things that are going on, and you can just feel that the tide is turning on some of this stuff. And it's not a moment too soon, to be honest with you. And I think that this is going to be wind at the back of the markets, and then we'll get a collapse here, just because we spent so much money. But in the short term, these are kind of the components that are providing the wind to the back of the market. And now all of a sudden, maybe businesses will rediscover that what the business that they're in is making good products or provisioning awesome services. They seem to have forgotten that. Why virtue signaling all over the place, especially in some of these large organizations. And to be honest with you, they are ripe to get picked off too, and deservedly so for some of this. Um, so anyway, that's kind of what I see happening. I think the bull market will continue, and some of the evidence that I look at. Well, let's first of all take a look at the markets, and let me bring this up. Okay. This is the Dow Jones Industrial. Remember last week? These are weekly data, and last week it went down. We had this head and shoulders form, inverted head and shoulders that usually results, when I say usually, about 60% of the time results in the markets going up about double the size of what it, from the head to the break, roughly 34,000 to about 3,000 approximately points, which would put us well over the all-time highs if this pattern does continue. We look at the SPY, we kind of have the same situation. You can maybe make a cup and handle out of this, but the thing I keep watching is, as I did back here, is it's recovering this kind of line that's been around for a while, which is good news. in the upward trend. And that's the SPY, the S&P 500, the Qs, which is primarily the makeup of the NASDAQ. We've got this big cup forming here. And again, all-time high, 408.71. Goes up, hits that. And then I think the irrational exuberance begins, and David Hunter's melt-up becomes a reality. Then IWM is the one that I'm watching. It's lagging. I personally am putting money into it. Boy, wound up. I just saw it. Well, it gapped up and then came back down for the day. But this is the one for me that I'm watching for all types of reasons. Let's go back to the weekly. All-time high is 244, whereas the Dow and the SPY and the Qs are all less than 10%, somewhere between 7 and 9% off of their all-time highs. The IWM is roughly, let's see, based on what we closed today, is about 30%, a little over 30% from its all-time high. So it's got some it's got some work to do. But this week we got a bullish engulfing candle. So you get the sense that maybe the tide's turning on that. And if we look at the breadth, which is really to me what the IWM is, the Russell, a lot of small companies, we started to, after last week where we finished down like in the mid 40s, we're back up above 50% of the companies above their 200-day average. And so, that's good news. We had, we looked at the 10-year yield. It was still trying, we keep inching closer to filling this gap up here. But and it probably will happen once the Fed, if they do wind up raising a quarter point the next meeting. I just don't think it's going to matter. We look at the DXY here. The dollar is kind of flat for the week, so we got a doji there. There's some decisions it's narrowing in on in another, few weeks or maybe before getting out of this channel here. And then we have crude oil's kind of been hanging out again as kind of in the same scenario as the dollar. The VIX still remains relatively low. Made that last minute comeback today, but it is low. So that's kind of the makeup of it. Now, why do I think that the Dow and all these will wind up going higher? Well, let's look at this. This is the MaximumPain.com. I like to go to this site. And if you just look over here on the left, how many puts? So in red is the put, in green is the call. Look at all the puts on SPY for July. Now what was SPY? SPY today, it's on there, 443, 444. Roughly 425 is maximum pain. We're already well beyond that. It could come back down. So, we'll see. But look, if we have this many puts and we got the market pushing this way, all of these puts are going to get squeezed. All these people have to cover their shorts, their short position. So all these people are betting the market's going to go lower. And that's a lot of people, 100,000, open interest. 154,000, there at 420. So, we'll see what happens here. If the market continues on its way up, all these people are going to have to close those short positions. And that will, because they're buying to close, they'll have to, could potentially be fuel for the markets to push higher. And, you look at all of these, let's look at maybe 818. There's just a lot of puts out there, people expecting the market to go down. And it kind of doesn't match what I'm seeing in the investor sentiment. Let's take a look at the AAII Investor Sentiment Survey. Now we've got, 27. We went from 27.8 to 27.5. So that's not much of a change as far as the people who are bullish. We came down a little bit, or bearish, and then on the bullish side we had reduced actually by a percentage, and we've got more people now. They're moving in the neutral camp. So all of these things are playing a role. And then the fear and greed index, is out there, at extreme greed. So, we'll see. Everything pretty much, market volatility isn't greed, safe haven demand. Okay. So let's go ahead and take a look at the economic calendar. And we'll start here. Obviously, Dallas manufacturing has been down for a long period of time. We have durable goods here that actually increased. And when I started to see some of these numbers, this is where I was like, okay, we're going to get a bigger correction coming here. And then we got the home prices up 1.7%, year over year down 1.7%. The CB consumer confidence 109.7, well, blew that out. New home sales up 12.2%. So, people are feeling good. And then we had the mortgage rate came out just slightly higher than the week before at 6.75%. The Powell speech was kind of a non-event. If anything, most of the FOMC members that spoke were a little more, accommodating maybe. Just seemed that way. Nobody came out and said, oh no, they're going to raise 20 times in the next 3 months. Initial jobless claims came in lighter. Again, all these things would normally be bad news because people would be fearing the Fed. And that's kind of why I say, the Fed is kissing the south end of a north moving bull market. They don't really care at this point. People don't care. Pending home sales down 22.2%. The GDP came in just under what the consensus was. And then on Friday, the big thing was core PCE, and it came in at 0.3%, in line with what the expectations were. And if it had come in at 0.2%, I guarantee you this thing would have gone to the moon today, as far as the markets go. And so, PCE price index year over year, 3.8% versus the previous, it was 4.3. So, there's a combination of things, good and bad. We have Chicago PMI at 41.5, still under the consensus, so the economy still shows weakening. Michigan consumer sentiment, the final for this week was 64.4%, better than the consensus, beating the previous period. So right now we're in this mode, and I don't know how long it lasts, but and it could last a while, where good news is good news and bad news is good news, and those things seem to be moving the market at this point. Now, take a look at the we want to go to next week, and what we can see, there's some significant things here. The S&P Global Manufacturing PMI, ISM Manufacturing PMI, still showing in contraction. We'll have FOMC minutes day after, Tuesday. Obviously, things close, and I believe they're on a shortened day on Monday. And then, so Wednesday, we'll get some feedback on the FOMC. Then we have mortgage rates, and we have initial jobless claims again, ISM services, the JOLTS job openings. But all these numbers are coming out stronger than expected. Non-farm payroll, expectation 225. I think it's going to blow that number away. Unemployment rate, 3.7%. I don't know whether that'll move or not. I don't think it matters. I think that's just where we are at this juncture with this market. So my final comments are really around the second half of this year. And, I seem to be into the quotes today, which, there was a movie called All About Eve, and Betty Davis was in it. And Margot Channing was the character, name of the character that she played. And her famous line is, "Fasten your seatbelts. It's going to be a bumpy ride." And that's all I can expect from really here on out. I'm curious to see how all of this plays out. My expectation right now is we're starting to, the tide's turning on some of these anti-business things. And some of you may think that, woke capitalism is an anti-business, but from what I've seen, it is. And, the irrational exuberance hitting in. I don't think any of this ends well ultimately, but if you can prep your mind for it, to take advantage of a blow off top, as far as the markets go, that David Hunter's been predicting, and a few people are starting to jump onto that bandwagon. The markets aren't rational because they're run by human emotion. And there are a lot of books out there, I think I've mentioned them in previous episodes, that kind of take you through, what happens. And I think that, we're going to get a lot of people trying to jump on, buying the tulips was one of the examples, from previous eras where the tulips, in Holland were going up in price, and then all of a sudden they were worthless. So, and I think we're going to probably have something very similar to that. But if you can mentally prepare yourself and also make yourself aware of the tools that are available. Now, I'm not sure anybody else trades options or how many people trade options, but you want to be in liquid options, for instance. That's at least my play, because if we need to get out of them because the market starts to go the other way, having people that are playing a lot in things like the SPY and the Qs and that are highly invested in the Russell, then you're going to have an easier time getting in and out of the markets when there's liquidity there. But if you don't, and you can usually tell by the spread, when you go to buy a put, if there's a $2 spread, it tells you there's not a lot of open interest in that particular underlying or stock in that option. So it's kind of getting yourself mentally prepared. Some of you will just decide, and I'm not advocating any of the things necessarily I'm talking about, but if you can at least get your mind wrapped around the fact that things can potentially, that the floor can drop out from underneath you, that you can prepare yourself both mentally, but also, get out of the market if you're only one of those people who invest, and things will eventually get back to normal. So even if it drops 80%, well, it may not. So prepare yourself, to kind of watch and see what's going on. Those that are really risk averse, they may be pulling their money out now. I don't think that's a good idea, but I'm not making any recommendations either, because everybody's situation is a little bit different. So my expectation is that this market will continue to go up, and I might be wrong. So that's why you have to make your own decisions about your own investing. But you should educate yourself at the tools that are available, and you may just shake your head and say, no, I'm not going to do that, and I'm just going to pull my money out when I think things get frothy in the market. So that's really what I wanted to cover. So I mean, this is going to be maybe I'm going to say over the next 6 to 9 months, probably. It'll probably last even longer, but over the next 6 to 9 months, I would say we're going to have a lot of activity. It's going to be, it is fasten your seatbelt time. It's going to be a bumpy ride. That's what I wanted to cover this week. And remember, there is always a better way.